We had a fairly strong week in the market. In fact, we're noticing not only green nearly right across the board, but the Mag 7 have rebounded fairly strongly. And today, under the spotlight, we have PepsiCo, which was down nearly 7%. Now, bear in mind, they did report just before the market opened on Thursday, which was one of the main reasons why we did see a large drop in this blue chip company. And if we do take a step back and just look year to date 2025, whilst the majority of the market is still trying to recover, trying to turn green, we have PepsiCo down double digits. We're talking over 12%, whilst others in this space like Coca-Cola are up 16% and KDP up 7% and Monster Energy up 12%. And that is our focus in today's episode, a company that has been battered. We're talking 25% in just the last 12 months, losing 1/4 of its market cap, a company that now trades at its 52-week low and does offer, for the first time, we're talking a yield of over 4%. Are we looking at an incredibly great opportunity for the longer term? Not just share price gain, but also dividends and increasing at a fast rate for a dividend king. But actually, is this a trap and one that we should avoid? And first thing you will note is that all three analysts, Seeking Alpha, Wall Street and Quant, do give this company a hold, but we'll also give you our own opinion throughout the episode. And if you just look at over the last 10 years, this company, again, we will show this, has massively underperformed the S&P 500, up only 40%. Now, before we get into the actual earnings and why this company has suffered a terrible drop, we'll first point out on a valuation perspective, the company now trades at a forward P of 16. That is significantly below the 5-year average of 23.9, and also now trading at a valuation that is the cheapest in over the last 5 years. That is one severe undervaluation signal. And if we flip it to the dividend yield, as we said, they now offer above 4%, 4.27%, which is significantly above the 5-year average of 2.88. We're talking for PepsiCo right now, a dividend king, two severe undervaluation signals. But one thing we should make you aware of is companies that look cheap can always become cheaper. And if we look at this third valuation space with the blue tunnel indicating the expected fair price based on the 5-year average P, we do in fact notice the current stock price, and for quite some time has been sitting below even the bottom end, and this disparity gives us our third severe undervaluation signal. So it does look like it could be potentially a great opportunity, and we will also run it through, as we typically do, our own valuation process to give you our own intrinsic price as well as what Wall Street do anticipate at least over the next 12 months. In terms of valuation, given we have just started on that, the overall grade does come to a C+, and we actually notice this company now pretty much trades in line with the sector, doesn't trade at a premium, doesn't trade at a discount, but as we've highlighted, a very large, we're talking 31% discount to what it has historically traded at, and something you can see regardless of what valuation metric you look at. PepsiCo is trading at quite a substantial discount to the 5-year. Again, doesn't mean it is a buy. This is what we do need to dissect in the episode, and we'll start off by looking at why this company did suffer that drop last week. And we can see they've cut their earnings forecast. They're predicting uncertainty, in which they do relate most of this to tariffs as well as consumer spending. So this is a bit of a warning signal, not just for PepsiCo, but also for other companies that are in fact in a very similar sector. And we'll also touch upon other companies that have suffered as such. But we can see here they have cut their forecast for their earnings per share. They're talking tariffs, economic volatility, as well as more cautious consumers who ultimately are either spending less on their products or moving away to cheaper alternatives. And we can see here directly from the CEO during that earnings call, he says we expect more volatility and uncertainty, and he puts this down to global trade developments, which ultimately he does envisage will increase their supply chain costs. Now if we look at the specific numbers against analyst targets, earnings per share 148, market wanted higher at 149, so a marginal miss. Revenue with a marginal beat, 1792 versus 17.77 expectation on the top line. And in terms of their bottom line net income, it came to $1.33 per share, which isn't the greatest when you consider from the same quarter last year they did in fact report 148. So we're not getting the best picture and starting to understand more why this company has fallen. And one of the key things that I do believe is attributable to other companies, not in fact just PepsiCo, but perhaps the likes of Procter & Gamble, which is very similar in terms of consumers and their behaviors, but they have come out and said consumers have remained value conscious across brands, across channels, and if you combine that with the inflationary pressures, that has ultimately strained their budgets as well as changed their food shopping patterns. One thing that maybe was understated is that they're saying to appeal to consumers that do use GLP-1 products, those who are looking to lose weight and maybe will move away from Pepsi products, they're planning to add more protein in their portfolio to drive those consumers back into the business, something that will be interesting to follow over the next few years. And we can also see from an article from the Wall Street Journal, they've come out to say that a sign that consumers are anxious, they're starting to cut back on snacks, and it isn't just this earning calls that has given them the confidence that we are starting to see a bit of a crack in consumers and their confidence, but they've also relayed here the exact same points that they did notice in both the Chipotle as well as Procter & Gamble's earning calls. So definitely we would say something to bear in mind, and that is why ultimately we always like to add a margin of safety when we do get to the valuation process part of the episode. Now bear in mind, this is a company that does sell a lot of snacks, but around 42% of their top line does also come in terms of their beverages, and in terms of the geographical mix, more than half, sitting around 60%, is sold to North America, with 40% sitting in the international space, and international is actually where we're seeing the largest driver of their growth in revenue. In fact, that's its double digit 10%, with North America sitting lower. And we can also show you their products for those that are maybe slightly unfamiliar, but these are products where consumers, as we said, are either buying less of their favorite goods, their favorite brands, whether it's Cheetos, Doritos, Mountain Dew, or actually moving away to cheaper alternatives, perhaps the likes of supermarket owned brands. Nonetheless, one thing I always like to say, regardless of a company and its performance, always try to understand what is their capital allocation, how are they going to return excess cash to your pockets, and one thing, as we've highlighted, we'll also touch upon the safety of the dividend, but that is something that is very key in the mind of management, and they are a dividend king, 53 plus years of consecutively increasing it, and sometimes we do get to see share repurchase, again something we will cover. And finally, from their latest investor presentation, if you are someone that is considering investing in the company or is a shareholder, you can see their targets overall is for revenue growth around the 4 to 6 percentage point. Remember, we typically advise, regardless of whatever you're looking at in terms of growth, minimum 4% just to keep up in line with inflation, and they also target high single digit in terms of earnings per share growth, something we actually haven't seen lately, but always good to really hold management accountable to their targets and ensure they are at a bare minimum coming in line. Now, in terms of their earnings expectations over the next 4 quarters, they only really anticipate 3 of them to be growth, and they're not the largest. We're talking around the mid-single digit on average, and they've also now got a 75% track record, 3 out of 4 beats against analyst targets, and as we can see, the most recent one was that marginal miss. Again, for those that do like to look towards December 2026, the next full accounting period, they're trading at a forward P around the 15.6 mark. The other thing we always like to do is see what are super investors doing, and we can in fact note there are some super investors that hold this in their own portfolio. Now, we are starting to get some of them trickle in terms of their updates for Q1 2025, and for those that we do have, they've actually been buying, although as you can see, not a large percentage of their overall portfolio, but more often than not, super investors do hold quite a number of companies in their portfolio, making up very small percentages. So we do get to see quite a substantial add from this super investor, as well as an additional position by Robert Olnstein. And we can see Q4 quite a lot, in fact, in 2024 that were reducing their position in the company. Again, the likes of Warren Buffett, Bill Ackman, Bill Gates, we will make you aware when they do release their latest movements for Q1, so ensure you are subscribed. Now, in terms of what the institutions are doing, they do hold 73% ownership. They sold around 17.6 billion over the last year, pretty much bought around the same in the same time frame, so neither bullish or bearish, but we can see in Q1 1.4 billion worth of buying, just under 400 million selling. So at least in the most recent quarter, institutions are a little bit more bullish than bearish. And if we look at insiders, what they're doing, very small percentage at 0.14. We notice 1 million of selling in the last year. No movement in Q2, no movement in Q1. In fact, you'd have to go back to Q2 of 2024 to see the movement. movement that is quite outdated, so we won't take a look at the detail, and typically our own opinion, insider selling isn't typically a bearish signal. They sell for many reasons, personal and financial. Now we'll also touch upon the underlying metrics of the company. Their dividend safety score does come in at 93, very safe, so that is good to note. In fact, especially as this does get higher and higher, and their most recent increase was around 5% just a couple of months ago, so good to see above the minimum 4% we do target, as we said, just to keep up in line with inflation. And the dividend safety score was reaffirmed a few months ago, ultimately meaning that a dividend cut for PepsiCo is highly unlikely. Now, for those that do like to look at some key metrics, i.e. how they performed in the 07-09 Great Recession, they actually increased the dividend, didn't cut, didn't in fact maintain. They had above average growth, -1%, S&P itself, -12, and they also outperformed the S&P, -35, S&P itself during that time, -55. And if we do zoom out and look at this Dividend King, over the last 5 years, dividend growth 7%, over the last 10, 7.7, so pretty decent if you do factor in the dividend growth that is above inflation. They are a dividend king, and in fact they've also been paying a dividend for the last 60 years without a reduction. Now we're going to show you where one of the main issue lies for this company, this Dividend King, and we will kick off with the free cash flow payout. As always, free cash flow over earnings data, which is susceptible to manipulation by management through accounting. We want below 70% for this industry. Reason why we target this, giving us faith that management will continue to increase at a very respectable rate. But just look from 2018, it has been above that consistently, but in 2024, we're talking triple digits. We see that in 2022 as well, and this is what we would say is a major red flag. What does it mean? Well, ultimately, management are paying out more in dividends than they're generating in free cash flow, not a sign you want to see. Now, we do anticipate over the next 12 months to come down to 70%, but really this isn't something we have seen pretty much since 2017 below that mark, so do bear this in mind. It is definitely a cause for concern, at least for the shorter term. Then we move to free cash flow per share, where we want consistent growth over the longer term. Not something we're getting, very inconsistent. In fact, no growth from 2015 to 2024, but we are expected to believe over the next 12 months a massive jump is incoming to $8.15, but that doesn't look too convincing given the latest earnings report. And sales growth, again, we do want to see 3 to 7%, 3 to 4, again, just to keep up in line with inflation. 2024, no growth, so in real terms, actually negative. And on a trailing 12 month, again, we get 0%. And it isn't a company that has grown its top line with a lot of consistency, a very nice growth percentage. And we can also note that when we do zoom out and look at it from a numerical basis, we're talking nearly 50% growth over the last 10 years. Again, things to make you aware of. And when we do move on to the shares outstanding, yes, we love it when companies return excess cash to investor pockets through share buybacks. Not something they typically do in vast quantities. Maybe perhaps something we will see given the share price is very low, at least in relation to history. But again, it will depend on whether management do believe the company is looking like an attractive opportunity. ROIC, one of our favorite metrics, 12% or more for the industry. Give us faith, management are able to effectively allocate their capital. Now, we do notice it has been above that consistently, around 16%, so this is one metric we do in fact like from the company. And then we move on to the margins. Now, operating margin, as we always say, first step at a bare minimum to be above that 16%, which is the minimum threshold for consumer staples. It pretty much straddles around that year on year. Ideally, what we want to see here for a high quality company, not only revenue growth, but also the margins efficiencies growing over time. So that isn't noted here. And on the free cash flow margin, whilst it has been decreasing over time, still, at least for the time being, it is straddling around that minimum 7% level. Again, just factors to make you aware of. Then move on to the final metric here, the net debt to EBITDA, below 4 for the industry, correlates to both dividend safety, balance sheet strength. Numbers you see below, number of years it would take the company to pay off all of their debt net of cash on hand. Around 2 on a trailing 12 month, marginal drop over the next year. So it looks like for now, balance sheet is okay, but bear in mind, free cash flow pound is very high, and this is something they do really need to focus on very soon, but not something we have seen for quite some time. Only thing we can think of is perhaps if they do increase the dividend at a lower rate moving forwards. We then move on to the growth grade where they get a D. Now year on year, not even 1%. Moving forwards, barely above 1%. And the sector, whilst in the low single digit, is still sitting higher. And over the last 5 years, they have grown their top line revenue at a faster rate in the mid-single digit. And in terms of earnings per share over the next 3 to 5 years, their investor presentation said in the high single digit, although we can see analysts are now only factoring 4%, lower than the sector at 7, lower than their own 5-year at 7.2, hence the overall degrading. We then move to the profitability grade where they get an A+, gross margin 55%, above the sector at 36, pretty much in line with their 5-year average. Bottom line 10.5%, above the sector median, and we can see pretty much in line with the 5-year, so their margins haven't really shown any growth over the period, but cash from operations has marginally increased, 12.5 billion over the last year, 5-year average 11.4, but significantly above the sector at 878 million. Now, for those that do want to see how the company has performed against others, for example, Coca-Cola in a similar industry, as well as some other companies we actually touched upon earlier, we can see total return, including dividends reinvested, PepsiCo not only the worst performing, down 22% over the last year, but actually only one of two that has returned negative, as we can see. Coca-Cola, for example, is up around 20%, and if we do expand it to over the last 5 years, again, PepsiCo the worst performing, up only 15%. For example, Coca-Cola in comparison up nearly 80, and over the last 10 years, we can in fact see a fairly similar story. PepsiCo one of the worst, Coca-Cola up 141, Monster a lot better, as well as KDP. So different factors to think about, but what we would say, whilst they haven't performed that great, at least over the longer term, past performance is not an indicator of the future. And the same thing we do want to highlight in comparison against the S&P. They've massively underperformed over the last year, negative 22, S&P up 10%. When we zoom out to over the last 5 years, we do note again massive underperformance, Pepsi 15%, S&P up 92. And over the last 10 years, the conclusion is the same, S&P has massively outperformed. We'll also quickly reflect on their income statement. Now, whilst we said their revenue has grown nearly 50% over the last 10 years, it isn't really the growth you want to see ideally for a company, even in this industry where it isn't that high in terms of percentage. But what we truly want to understand here is, what does the bottom line net income tell us? Is it at least a fairly consistent story? And for the large part, you could answer yes. We see their bottom line from 5.5 billion 10 years ago to now sitting at 9.6, but we do also notice some years where it has been a little bit inconsistent. Again, just factors to consider. And we'll also show you, very importantly, the balance sheet, a quick total cash versus total debt for a health check. Cash has actually, whilst being inconsistent, decreasing 12 billion 10 years ago, now sitting at 8.5 billion in that latest quarter, Q1 FY25. But as always, we never compare this or look at this in pure isolation. We like to look at this against the total debt, both numerically and directionally, and we can see that has, for the large part, been increasing, going from 34 billion in 2015 to now at 49. So whilst cash has been decreasing, debt has been increasing. Definitely something to factor in, and not particularly a great sign. Now, do also bear in mind the wider global factors that have caused this company to come down, as we've seen from their latest earnings. But at the moment, we have moved away from extreme fear, where we were in the low single digits just a few months ago, to now sitting in fear. So maybe if sentiment does start to get better, we will see investors consider this opportunity, and perhaps the tariff situation will help ease a little bit of anxiousness on PepsiCo's consumers. But what we would say is, when we look at the S&P and we do zoom out in terms of a forward valuation basis, a lot of companies are still looking overvalued, looking very high in terms of the numbers. We have some that are sitting at 25, 30, 35, but one thing that we would give credit to PepsiCo at the moment is that the company is sitting in potentially an attractive opportunity around the 15 to 16, as we highlighted earlier, not just the lowest over the last 5 years, but also against the sector, it's now pretty much trading in line. If you look at Coca-Cola in comparison, it is sitting at 22.5, but maybe you could argue Coca-Cola is a higher quality company. Lots of things, again, just to bear in mind. And before we get into our own valuation process, we do want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox, where we cover severely undervalued stocks, as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to grab a copy of 35 severely undervalued stocks for the month. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, you can sign up and read straight away. We then move into our intrinsic value, which for PepsiCo today gets to $161 based on the earnings data. As you can see, the average of these three models, and we're going to run through very briefly each one so you can see how we've arrived at the value. First one, multiples valuation, companies in a similar sector and size. Average P multiplied by the EPS of PepsiCo to give us our first intrinsic value showing undervaluation. Bear in mind though, we're not looking at any one of these models in pure isolation. And then we move on to the dividend discount model. We can see fairly attractive growth over the period. On average, 7%. Moving forwards, to be more conservative, we've gone for 5.25, giving us our second undervaluation signal. And then we move on to the third one, the discounted cash flow model. Free cash flow year on year, average growth at 0%. We've gone growth rate moving forwards at 7. Based on the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get our intrinsic value, giving us our first overvaluation signal. So 2 for 1, as we said, intrinsically though, it is just the average of these three, and you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for PepsiCo or any others. But we're not done there because we always apply a margin of safety, 10%, execute on that if it meets our 3 golden criteria, wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, a buy at $145, then we keep going till it's near the current trading price. And in essence, what we're saying, not a 20% MOS just yet, but for PepsiCo, 15 to 20% may be sufficient for investors, maybe not. At 20, as we saw, a buy at 129, at 25 at 121, and at 30 around 113. But as of today, 15 to 20%, Wall Street themselves see this at $162 over the next year, in turn translating to 22% upside. So in your opinion, based on the information we ran through today, margin of safety 15 to 20, upside from Wall Street 22%, do you see PepsiCo as a buy, hold or sell? And don't forget as always to sign up to the free weekly newsletter. We are dropping a fresh copy on Monday morning. Grab those spreadsheets, join us in the Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.